Warren Edward Buffett is an American business magnate, investor, and philanthropist. He is currently the chairman and CEO of Berkshire Hathaway, an American holding company based in Omaha, Nebraska. He is one of the most successful investors in the world and has a net worth of over $113 billion as of June 2022, making him one of the world's wealthiest people. The majority of Warren Buffett's investing career has been devoted to combating inflation. Several times during his shareholders' meetings and Berkshire's annual letters, Buffett discussed the effects of inflation and what it meant for stocks, businesses, and investors. In this video, we will discuss some of Buffett's recommendations on how to combat inflation. Stay tuned because we will discuss how you can also apply them in your life. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. The continuous release of stimulus checks during the pandemic, the high investment in green energy infrastructure, and China's growing economy that competes with the US have definitely resulted in inflation. Commodities such as palladium and steel are now priced at their all-time high. This is why Warren Buffett suggests that the Federal Reserve should really try to boost interest rates to fight inflation because he is concerned that company valuations could be affected if the current economy shows indications of overheating. However, the Fed's policymakers appear to be apprehensive as well and have signaled a desire to grant initial freedom to accomplish employment goals. And Buffett also pointed out that the inflation we are facing today is the result of consumer savings over the previous years. Warren Buffett and his take on inflation. Some claim that the United States' greatest macroeconomic failure since World War II occurred between 1965 and 1982. Inflation peaked at 14% during that time period, which is why it is also known as the Great Inflation. Mortgage rates also reached a 20% high. During those periods, Warren Buffett was already an investor, so he knew firsthand its effect on the economy, businesses, companies, the stock market, and even on the lives of ordinary workers. He saw the hardships. This is why up until now, he is still continually on the lookout for signs of inflation, so he is 100% prepared when that time comes. And in 2010, Buffett predicted that inflation will also happen again in the near future, even as the Federal Reserve kept up its quantitative easing campaigns. He explained how the inflation tax has the power to completely absorb capital, even when investors thought they were profiting. Instead of gaining, they are actually losing in their investments. This is why it is important to review Buffett's recommendations for battling inflation in the light of the economy's strong price increases brought on by the low interest rates and the Federal Reserve's continued money printing. Here are some of them. Number 1. Avoid investing in bonds. Buffett stated several times in his annual shareholder letters that bonds are not the right investment when it comes to beating inflation. Bondholders who chose to stay invested in a highly inflating economy with interest rates at record low will most likely suffer large financial losses. Buffett notes that buying a 10-year bond that will yield only 2% per year is like paying 50 times earnings for a stock. The fact that bonds' earnings cannot increase is the main distinction between the two asset classes. Flexible income investors face a dreadful future because rates aren't expected to rise in the near future. Number 2. Invest in businesses that can raise prices in times of inflation. Buffett asserts that a company's pricing power is the single most crucial criterion for evaluating a business or company. He believes that a company is running a very good operation and has a high potential for great returns if it could raise prices without losing customers to its competitors. In one of his annual shareholders' meetings, Buffett stated that an unregulated toll bridge could actually be the best asset to own during an inflationary period since you could build the bridge one time, but you can continue to raise prices indefinitely. So by investing in businesses that can raise their prices even in times of inflation, you wouldn't have to worry about returns on investments. You wouldn't have to worry about inflation at all. There will always be a demand, so customers and returns will continue to pour in as well. Number 3. Invest only in reputable companies. Before deciding to invest in a company, Buffett always had in mind to search for companies that have both a low capital requirement and a high return of capital being invested back in the company. Thus, according to him, has a high potential for great returns. and comparing them to capital-intensive companies, which must continually invest larger quantities of money to retain their existing position in the market, businesses with modest capital requirements would perform better during inflationary times and would be able to sustain their profitability in the long run, no matter how high the inflation will be. So instead of investing in companies that offer high returns but the background is questionable and the capital requirement is high, you should instead consider investing in a reputable company that requires only low capital and is continually reinvesting the returns back in the company. Before we move on to the next recommendation, if you love content such as this, give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. We'd love to give you more content such as this. Now moving on to number 4, control your spending. In 2004, Buffett's business partner Charlie Munger asserted that cutting back on wasteful spending is the greatest strategy to combat inflation. Munger added that individuals would have a strong defense against inflation if they didn't create artificial demand to drown in consumer goods. Additionally, Munger also stated that having a significant consumer debt can make life more difficult when inflation is strong. Because instead of focusing their resources on things that can help them beat inflation, they are stuck paying their consumer debts. Interest rates climb along with inflation. Higher interest rates would be incurred if you have debt with adjustable rates, such as credit card debt and consumer debt. So Munger encourages people to pay their consumer debts as soon as they can, because when inflation comes, it will only add more burden to you as a consumer. Number 5. Always invest in yourself first. Buffett argued that investing in yourself is the best method for you to keep your purchasing power over time. Buffett claims that even when an engineer or lawyer receives schooling that is paid for with old money, they are still able to charge for their services with modern money without having to relearn it. This means that your investment in yourself today will yield you returns for a lifetime. You don't have to relearn it in the same way that you don't have to go back to school again once you earn that degree. Once you've gained the skills and lessons, you can use it as long as you live. So even though getting an advanced degree can be expensive, it can also expand your knowledge and help you gain valuable skills. You can even demand more earnings over time by improving your value to companies and clients. Number 6. Avoid investing in gold. In his entire investing life, Buffett has avoided investing in gold, which is frequently used as a hedge against inflation. Instead, Buffett believes in investing in stocks, real estate, and farms rather than gold, despite the fact that investors in gold are particularly concerned about the impact of inflation on money. According to him, if you bought an ounce of gold now, you would still have that same ounce of gold at the end of time. However, if you invested in stocks or farmland, the investor would be able to receive dividend income or products, and owning productive assets would grow in value over time aside from the returns you are currently gaining. Buffett firmly believes in this, and his opinions haven't changed despite the fact that Bitcoin has also recently been called the digital gold. He actually believes that Bitcoin produces nothing and has no special value at all. And that's how you can handle inflation according to Warren Buffett. What do you think of Buffett's position on inflation? Do you think he's right? And how are you coping with the inflation today? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!